While you were sleeping, 5 nations quietly finalized an agreement that just rewired the backbone of global finance without a single headline in the Western press. They call it the Digital Bridge Pact. This isn't a proposal. It isn't a pilot. It's live, operational, and already processing real transactions that bypass the US dollar entirely. And almost no one here is talking about it. The 5 nations are China, Russia, India, Saudi Arabia, and the United Arab Emirates. These aren't fringe players. They are the largest energy producers, the biggest manufacturing hubs, and the fastest-growing consumer markets on Earth. For years, they've been coordinating outside the Western-led institutions, outside SWIFT, outside the IMF, outside the dollar-centric rules most of us still assume are permanent. This isn't random. It's deliberate, patient, and led by their central banks with coordination that reaches all the way up to the highest levels of global finance. It's a shadow alliance that has been assembling piece by piece while the rest of the world was focused elsewhere. To understand how big this is, you have to see how fragile the dollar's position has always been. After 1971, when the US left the gold standard, a new arrangement was born, the Petrodollar system. The deal was simple. Oil would be priced and settled exclusively in US dollars. And in return, the United States would provide military security to key oil producers, especially Saudi Arabia. That forced the entire world to hold dollars, to buy dollars, to lend dollars back to the US through treasuries. It looked permanent. It felt like a law of nature. But it was always a temporary agreement, never an eternal guarantee. And now the core partner in that deal, Saudi Arabia, is openly moving in a different direction. They just joined the mechanism that lets them settle oil and trade without ever touching a dollar. The old arrangement is breaking, and the nations who relied on it for decades knew this day would come. They've been preparing their exit for a long time. Here's how the current system still works for most people. When two countries trade, even if neither is the United States, the payment usually routes through SWIFT, a messaging network dominated by Western institutions. The actual settlement happens through correspondent banks, and almost always in US dollars. That means everyone needs dollars on hand, which keeps global demand high and lets the US borrow at rates no one else can match. It's slow, it's expensive, and it gives the United States enormous leverage, because any country can be cut off if it steps out of line. The digital bridge is the opposite. It's a shared platform that lets central bank digital currencies settle trades instantly, directly between participants on a distributed ledger. No correspondent banks, no dollar intermediary, no exposure to sanctions. Think of it as moving from sending money through the US postal system, where every package gets inspected and can be delayed or seized, to sending it peer-to-peer on an app that no single country controls. That shift just went live, and once you see it, you can't unsee how vulnerable the old system has become. The turning point came quietly, without fanfare. In the final days of January 2026, representatives from the central banks of China, Russia, India, Saudi Arabia, and the United Arab Emirates formally activated the next phase of the digital bridge platform. This wasn't another pilot or proof of concept. Real cross-border settlements, actual commercial transactions, are now flowing across the system. The technical breakthrough is straightforward but profound. A permissioned distributed ledger that allows direct, atomic settlement between participating central bank digital currencies and tokenized commercial bank deposits. No intermediaries, no delays, no single point of control. Transactions that once took days and passed through multiple dollar clearing banks now clear in seconds. The platform is already live for selected banks in each country, and transaction volumes are scaling rapidly. This is the moment the alternative system stopped being theoretical and became operational reality. Countries around the world now face a clear, practical choice. They can stay anchored to the old SWIFT correspondent system, slower, more expensive, and fully exposed to unilateral sanctions. Or they can integrate with Digital Bridge, faster, cheaper, and designed to be sanction-resistant. It's not ideology driving this decision. It's simple economics. Early participants are already seeing lower costs and faster trade execution. Those who hesitate fall behind in competitiveness. That pressure is already visible in trade corridors across Asia, the Middle East, and increasingly Africa and Latin America. This creates a chain reaction that's difficult to stop once it gains momentum. As more countries run tests and route real transactions through Digital Bridge, volume grows. Higher volume improves liquidity and reduces spreads. Better liquidity attracts more participants. Each new participant reduces relative demand for dollars in trade settlement. Reserve managers, already cautious after years of weaponized finance, begin quietly diversifying holdings. They don't need to dump treasuries overnight. They just stop accumulating new ones at the same pace. Dollar demand softens further. A weaker dollar pushes up import costs for the United States. Higher import costs feed into domestic prices and force higher yields to keep capital attracted. Higher yields slow growth. Slower growth makes the dollar even less appealing globally. The loop reinforces itself. We've already seen the early stages. BRICS nations increased local currency trade share from under 10% a decade ago to over 30% today. Russia-India oil trades now largely bypass dollars. China-Saudi energy contracts increasingly settle in renminbi. These were once dismissed as symbolic. Now they have a live platform to scale. The Federal Reserve's usual tools lose their power in this environment. In past crises, global dollar shortages forced the world back to the Fed for liquidity. This time, the alternative is already built and operating. Printing more dollars doesn't create demand if trade no longer needs them. The dollars just sit as excess reserves or flow into domestic inflation, without restoring the privileged global position. This is different from every post-Bretton Woods episode. The gap between paper claims and real-world utility is widening. Treasuries, dollar cash, dollar-denominated bonds, these are ultimately claims on future dollars. But if global trade shifts to direct settlement outside dollars, the real demand backing those claims shrinks. Contrast that with assets that directly facilitate or settle actual trade: commodities, gold, productive infrastructure, control of alternative payment rails. Central banks understand this clearly. That's why we've seen record gold purchases for 4 consecutive years, led by the same nations building Digital Bridge. China, India, Russia, all adding hundreds of tons annually while publicly saying nothing dramatic is changing. Their actions speak louder. The wealth transfer this sets in motion is straightforward. Those overexposed to dollar-denominated paper assets will bear the adjustment. Those positioned in real assets, commodities, gold, and systems with non-dollar settlement power will preserve and, in relative terms, gain purchasing power. It's not about getting rich quickly. It's about not being on the wrong side of a structural shift. Watch what insiders actually do, not what they say in press conferences. Central banks continue accumulating physical gold at the fastest pace in decades. Sovereign wealth funds in the Gulf and Asia are increasing direct commodity and infrastructure exposure. Corporate treasurers in export-heavy economies are quietly building non-dollar liquidity buffers. Public statements remain calm. The dollar remains dominant. No material changes expected. Private balance sheets tell a different story. The old rules of wealth preservation that worked for 50 years are being retired, whether we acknowledge it or not. The 60-40 portfolio assumption that U.S. stocks and treasuries balance each other indefinitely no longer holds when both are priced in a currency losing trade dominance. The idea that treasuries are inherently risk-free ignores settlement risk in a fragmenting monetary order. A reflex to just buy the dip in U.S. assets assumes endless global demand to support valuations. That demand is now conditional, not guaranteed. We are watching the quiet expiration of rules most investors still treat as permanent. Once you see the mechanics clearly, the outcome starts to feel less like speculation and more like inevitability. This isn't just a story about central banks and trade corridors. It's about what happens when the shift reaches your daily life. The first effects will show up quietly, then accelerate. As dollar demand in global trade falls, the currency weakens against goods and services the United States imports: energy, electronics, clothing, raw materials. Those higher import costs don't stay at the port. They work their way through supply chains and end up in higher prices at the pump, the grocery store, the online checkout. Your purchasing power shrinks, even if your salary stays the same. Retirement accounts heavy in U.S. stocks and bonds face a double pressure. Nominal valuations may hold or rise with inflation, but real-world buying power erodes. If the adjustment intensifies, we could see friction in the transition. Tighter credit conditions, potential restrictions on capital flows, or a forced pivot toward domestic digital dollar systems that come with new rules and monitoring. Most people won't connect these changes to a platform operating halfway around the world. They'll just feel the squeeze. The process feeds on itself in what economists sometimes call a doom loop. Falling trade demand weakens the dollar. A weaker dollar forces yields higher to keep foreign capital from leaving treasuries. Higher yields weigh on growth, making stocks less attractive, housing more expensive, business investment slower. Slower growth reduces the appeal of holding dollars even further. Each turn of the cycle pushes more volume toward the alternative system, accelerating the shift. Once a critical mass of global trade routes through digital bridge, the loop becomes self-reinforcing and very hard to interrupt. History offers a clear parallel. The British pound was the undisputed reserve currency for a century, backed by the world's largest empire and navy. After World War I, debt, war costs, and shifting trade patterns began eroding its position. The process took decades, from the 1910s through the Suez Crisis in 1956. But it followed the same logic. Alternatives emerged, confidence waned, capital flowed elsewhere. The pound never collapsed dramatically. It simply faded from dominance. This transition can move faster. Digital infrastructure compresses timelines that once took generations into years or even months. Extreme outcomes like Weimar-style hyperinflation or Zimbabwe-style collapse aren't the base case. They require specific policy errors on top of the structural shift. But they remain possible warnings if the adjustment is mismanaged. We are crossing into a genuinely multipolar monetary era. For the first time since the late 19th century, no single currency will enjoy unquestioned dominance in global trade settlement. The United States will remain a major economic power with a large, deep financial market. But the dollar's role as the default settlement currency for everyone else's trade is ending. Digital Bridge isn't just a technical platform. It's the infrastructure layer of the new order, neutral enough to attract participants, resilient enough to withstand pressure, efficient enough to outcompete the legacy system. If you understand this shift now, you're already ahead of the vast majority who still assume the old rules are permanent. Most institutions, advisors, and households are still operating under assumptions that no longer match reality. That gap creates time for those who see clearly to position gradually and deliberately. There's no need for panic, no perfect escape, no guaranteed outcome. But awareness itself is the first real advantage in a transition this large. The people who adjust early won't just survive the change, they'll be the ones least affected by it. There is no magic fix here. No single asset, no secret strategy, no timing the market perfectly that will make this shift painless. No one, not me, not any economist, not any central bank, can tell you exactly how fast this will play out or how severe the adjustment will be. What we can do is reduce exposure to the biggest vulnerability. Being entirely dependent on a single currency system that is quietly losing its monopoly on global trade. The steps are straightforward, unglamorous, and require discipline over time. Start by honestly assessing your own balance sheet. How much of your wealth is tied to dollar-denominated paper? Cash, bonds, stocks, retirement accounts? If the answer is nearly everything, the first move is to gradually reduce that concentration. Diversification isn't about speculation or trying to outperform. It's about acknowledging that the rules have changed and acting accordingly. A portion in physical gold, allocated, stored securely, remains one of the few assets with no counterparty risk and a proven role across monetary regimes. Commodities and real productive assets, energy, agriculture, infrastructure tend to hold value when trade settlement fragments because they are needed regardless of which currency dominates. Exposure to stable jurisdictions or systems less reliant on dollar intermediation can also help. None of this is a guarantee. None of it promises wealth preservation or outsized returns. It simply tilts the odds away from being fully exposed to the losing side of a structural wealth transfer. Do this gradually. Dollar cost average where it makes sense. Avoid leverage, avoid panic selling, avoid get-rich-quick schemes dressed up as solutions. The people who navigate transitions like this best are the ones who act deliberately, early, and without emotion. The window to adapt calmly is still open today. More countries and corporations are integrating with the new platform every quarter. Transaction volumes are compounding. The feedback loops we've discussed don't reverse easily once they gain momentum. You don't need to rush, but you also can't assume unlimited time. This isn't about fear, it's about clarity. The shift is happening whether we acknowledge it or not. Those who see it early have the time to adapt on their own terms.